Let's delve into the oil market, and this is where we're really seeing a lot of changes coming to the fore. We had the Chicago Mercantile Exchange hiking margin requirements, this prompting quite a big sell-off in the oil market. And then we saw some positive numbers coming through from China. Chinese crude oil imports in April, the third highest on record. And this obviously pointing to the fact that demand is very much intact.
No, definitely. That just brings into it simply, so we saw that sell-off last week with the oil price declining by the most in nearly 2 years since the last time in 2008, and we saw prices stabilizing somewhat towards the end of towards the end of last week after positive data out of the US suggesting that non-farm payrolls came out better than expected. So that just once again indicating that the US economy is also, the recovery in the US economy is also intact, and combining that with the recovery with the Chinese economy suggesting robust demand coming out of China. So combined, we likely to see commodities and including the oil price simply to go higher from here onwards.
So I mean, we're sitting at $117 a barrel. Are you expecting even higher Brent crude prices from here onwards based on the demand, supply-demand fundamental factors?
Our house view is for Brent crude to average $111 a barrel this year, but that means that we will. Our view is for the oil price to eventually decline to around $100 a barrel by the end of this year. So in the short term, definitely supply side factors remain elevated. Demand, we expect demand factors to remain supported by Chinese demand, modest global economic activity to support demand factors. So combined supply tightness combined with demand strength, we should see oil supported at these levels.
A very different rhetoric from what we're hearing coming out of OPEC, that supply perhaps is over-exceeding demand. And this is obviously a very interesting factor that's been playing out since the beginning of the year, given the fact that we saw a lot of crises playing out in the North African and Middle Eastern region. From your end, it seems that demand is starting to exceed supply. Could OPEC then come to the fore and change rhetoric? What are you reading into the story?
What I'm seeing is that supplies have come off sharply. We're still seeing Libya, supplies out of Libya remaining shut in, so that has continued to weigh on supplies out of OPEC, out of the OPEC countries. And we are, on the other side, however, supplies out of the US have remained elevated, with crude oil stocks simply remaining at record highs in the US. So it's a difficult one to assess, but we continue to see supply tightness given the robust demand conditions and strong demand. We're going into the seasonally high demand periods in the US as well, where US driving season from May to September onwards. So that should also continue to support supply demand side factors going forward. However, we do caution that downside risks have increased of late. The persistently high commodities prices, food and fuel, have started to eat into personal consumers' incomes, so that has weighed on
so
demand.
Less driving, perhaps, and of course we know gasoline prices in the US sitting around $4 or so. Let's delve into the gold price. It's also fascinating to see the volatility there. We saw gold prices plummeting around 6%. We know last week. We also know that silver plummeted around 27% or so. Where do you see the investment metals going at this point in time, especially with the precious side of things, given the fact that gold is still viewed as that alternative safe haven asset? Yes,
so we have seen that gold just retracing and retracing some of the losses that it experienced last week. It's back above that $1,500 an ounce level, and our view is for gold to average $1,450 an ounce this year, largely on the back of persistent investment demand for the asset as a safe haven and as well as an investment demand asset. So that should simply continue to support gold being also seen more as a currency as opposed to a global economic indicator. So all these factors should continue to push that gold price higher over the next year.